Welcome to today's deep dive. Imagine going to sleep on a Tuesday and waking up to a global crypto market that just spontaneously generated $190 billion in value out of thin air.
Yeah, just a casual Tuesday, right?
Right. I mean, that's exactly what the sources we're analyzing today are detailing from this explosive August 2026 breakout. We're on a mission to figure out not just what triggered this historic shift, but, why it fundamentally alters your understanding of global finance.
Absolutely.
Okay, let's unpack this because the sheer scale of the move is just staggering. I mean, over a single week, Bitcoin shot up $14,000 to hit an intraday high of 79,500.
It is staggering, and the rest of the board completely lit up right alongside it. Ethereum blasted past 2,380. Solana aggressively reclaimed at $92.
Wow.
Yeah, I mean, the entire digital asset ecosystem just went completely vertical.
But I'm looking at these numbers, though, and fundamental demand alone doesn't really explain a $14,000 jump in 1 week. I mean, there has to be some sort of mechanical failure somewhere in the market causing this, right? Like a highly compressed coiled spring finally snapping.
Yeah, you're exactly right to look at the mechanics there, because when Bitcoin smashed past that $70,000 resistance block, it didn't just invite new buyers. It triggered this massive $3 billion liquidation cascade in the derivatives market.
Wait, 3 billion?
$3 billion. In a 24-hour window, over 170,000 traders who were betting the price would go down just got entirely wiped out.
So it's essentially this massive game of high-stakes musical chairs. Except if you don't get a seat when the music stops, you are contractually obligated to buy a chair at whatever price the person sitting down is asking.
That is a great way to put it.
And when 170,000 people suddenly need to buy a chair to cover their losing bets, the price just goes to the moon.
Exactly. What's fascinating here is how this derivatives unwinding severely accelerated the initial breakout. The underlying demand lit the match, but that forced buying from the short squeeze, that was the jet fuel.
It turned a strong week into a historic $14,000 candle.
Exactly, yeah.
But wait, the derivatives market provided the rocket fuel, but those derivatives don't liquidate themselves.
Yeah.
I mean, something had to spook those shorters into making a mistake in the first place.
Right, there had to be a spark.
So here's where it gets really interesting, because the sources point directly to the broader economy, specifically this historic turmoil in the U.S. bond market and a weakening U.S. dollar.
Yeah, as global borrowing costs became really erratic, we saw this massive flight to hard assets. Capital was just aggressively rotating out of fiat.
Like traditional government-issued money.
Right, like the dollar. People were looking for lifeboats. And it wasn't just Bitcoin surging, by the way. Gold also hit a 3-month high of $4,600.
Oh, well, so you have this macroeconomic storm brewing. But at the exact same time, the political climate around crypto in the U.S. just, completely flips from fear to extreme optimism.
It did. The sources highlight a few really effective, albeit impartial, political catalysts here. Major voices started calling for Congress to swiftly pass the Crypto Clarity Act.
Which is huge.
It is, and simultaneously the CFTC made these public efforts to integrate decentralized trading platforms, like Hyperliquid, into compliant U.S. frameworks. Suddenly, the regulatory clouds are just parting.
And traditional Wall Street institutions clearly saw the opening there. I mean, U.S. spot Bitcoin ETFs reversed their outflows and absorbed over $650 million in just 3 days.
Yeah, the demand just flooded back.
But the part that really jumps out is SIBO filing for 3x leveraged spot Bitcoin and Ethereum ETFs. Wait, for those unfamiliar, traditional institutions are essentially asking for products that drastically amplify market swings, right? Like they aren't just looking for a safe entry. They actually want extreme volatility.
That's the key takeaway right there. They aren't just dipping their toes in anymore. They are actively repricing these digital assets for an extended run. They are demanding the heavy-duty financial plumbing needed to trade them really aggressively.
So what does this all mean, for you listening, trying to navigate the long-term outlook?
Well, if we connect this to the bigger picture, macro analysts are pointing to a real structural shift in the BTC to gold ratio. Bitcoin is currently breaking out against both fiat currencies and physical gold.
Right.
Structurally, the sources suggest the 2026 macro bear phase is officially over. We are entering a new cycle driven by two main forces, which are ongoing dollar dilution and AI capital efficiency.
Wait, AI capital efficiency.
Yeah, as artificial intelligence scales, it requires programmable, frictionless networks to move value instantly across borders. And digital assets provide that infrastructure in a way that traditional banking simply can't match.
So the tension in the traditional financial system finally broke, and all that capital rushed into the most efficient pipes available.
Which leaves you with a fascinating question to mull over. If traditional financial institutions are actively demanding 3x leveraged crypto products right at the exact moment the U.S. bond market faces historic turmoil, are you witnessing a permanent rewiring of what the world considers a safe haven asset?